At the end of the last portfolio update, I started to sound a little downbeat. It had been a rough November at the time, with the old portfolio getting nuked and the new portfolio making money, but not as much money as the index did during the same period. This month, I've got a lot more reasons to be upbeat, however. The old portfolio reversed a little bit of its recent losses, and after taking a short breather, the new portfolio has gone straight back to printing cash. We are currently looking at a 22.5% year-to-date gain for the new portfolio. It's only been 6 months. These are literally Warren Buffett numbers I'm pulling right now, and we've still got 5.5 months left in the financial year. And accomplishing this has involved almost no trading activity over the last 2 months also. I'm holding largely the same stocks in the same quantities as at the start of December, but there's been a lot of really strong price action, including from some unexpected places. But first, let's start with the one trade that I did make. In January, I decided to halve my BRI holding, bringing it down to around 5% of the portfolio, making it my now smallest holding. The main reason for this is that even though the construction industry crisis is largely over and the recovery is in full swing for builders, these things don't happen all at once. I realized I may have jumped the gun a little bit on getting into the materials suppliers too early. The impacts of all the builder bankruptcies on the raw materials suppliers haven't necessarily finished flowing through yet. Add to that the fact that building approvals are still quite low, and last quarter's softness in frame and truss sales, which is a leading indicator of raw material demand since the frame is one of the first things to go into a new build. And all in all, I'm not expecting the best quarterly out of BRI this month. But I haven't sold out completely, and that's just the reasons that I sold BRI specifically. The main reason that I wanted to sell something is because I found another ticker I wanted to add to the portfolio. Reporting season is starting very soon, and I went ticker hunting in anticipation, since if I suddenly had to sell something in response to a bad report, I like to already have an idea of where I'm going to put the money before I have to sell. But, once again, we somehow still don't have any tickers substantially down from our entry price, which means that if I was going to buy more shares without overcapitalizing, I was going to have to hunt for a new company. Again. Honestly, having none of the new portfolio stocks substantially in the red is pretty impressive in and of itself. The main portfolio has had more than 10 companies on its books at some point or another, and being 10 for 10 on them either going up or sideways is pretty impressive in my opinion. I started my ticker hunt the same way as last time, with a value screen. I even used mostly the same parameters as last time, but I loosened the market cap restriction to allow anything over $200 million, since it turns out, now that AKE has merged into LTM, there's no options tradable over it anyway, so I can't sell short puts no matter how much collateral I build up, which is disappointing. This value screen led me to 2 companies, one of which I won't go into because it's in the maybe later basket, and another which I immediately bought with the proceeds of the BRI sale. This new holding is a mining services provider called SRG Global. They're making big bucks and have steadily grown over the last few years, and their pipeline of new work is at an all-time high, showing robust demand. Even if they stopped growing, the earnings yield alone from this stock makes it worth holding, but I do expect future growth, and I expect that to also drive additional share price appreciation. There's a very special place in my heart for steadily growing mining services providers. Many years ago, one of my big picks was MAD, or Mader Group, which provided heavy equipment maintenance to mining operations. I held it for a couple of years and sold it for a 50% profit when I needed to free up the cash to buy my house, only for it to increase another 300% after I'd sold. Now, I'm not saying that SRG is going to put in a performance like that, but if they continue to post that slow and steady growth in profit year after year, I might think twice about flipping this one for a 50% gain. But we'll see. Anyway, that's the trades. Let's get to the movements. The biggest mover over the last 2 months has been, by far, Capral, or CAA, once again. I started to look pretty dumb for buying more Capral at $9.18 per share, since the moment I did that, it dipped down to $8.40 and stayed there for a better part of a month. However, it doesn't matter if you trade like shit when the picks are good, and the pick turned out to be good after all. Since my most recent purchase at $9.20, it's gone up by 10%, and compared to my average acquisition price of $7.77, Capital is up 30%, making for a financial year-to-date gain of $16,000 of capital gains. And that's not including the $1,000 of dividends I pocketed along the way. Capital has performed so well that it's starting to mong up the y-axis on my profit and loss chart. This chart topped out at $6,000 the last time I showed it to you. Now those $5,000 gains on BIS and CRN are dwarfed by the huge green schlong that is my unrealized capital gains. As I said last time, I am planning to hold this one until the end of the financial year, but that primordial urge to hit the sell button as soon as I see green is starting to kick in as it creeps ever closer to my target range of $11 to $12. But I want my tax break, goddammit, and there's a very good chance that it's just going to keep sailing higher, so we hold. If the price moves sideways for the next 6 months, I'll save $3,000 in tax by continuing to hold. But I'm optimistic that we're more likely to see $11 than we are to head back down to $9, so I shouldn't even want to sell. I just need to chill the fuck out. The next big mover is Hum. This one actually really surprised me. I wasn't expecting Hum to really start moving until after the half-yearly report comes out, which is next month. And my original plan had been to wait for that to come out, confirm the results are good, and then buy more based on what I saw in the report. But it's gone up way ahead of schedule, which is fine, I guess, because it's not like I have an abundance of funds anyway, so it's not like I could buy a huge amount more Hum. But as of the time of writing, Hum is up 21.6% over my entry price. My main disappointment with this is I only had about $16,000 worth to my name when the rally started, meaning that this 20% rally, which is a huge number in percentage terms, has only generated $3,600 worth of capital gains for the portfolio. Still, it's better than a kick in the balls, and who knows, if the quarterly is good, maybe it'll do another 20% next month. As I've said in the past, my valuation for Hum is really uncertain until I can be confident they've gotten their shit together, so until February I have very little idea of what price I should sell this company at, or if I should even sell it at all. But I'm looking very tentatively at 70 cents per share as a target, which would be a roughly 60% gain. For most of the rest of the portfolio, it's been a quiet 2 months with no major news, dividends, or reports to speak of. But thanks to the efforts of our 2-star performers, the portfolio value has surged a whopping $15,000 over the Christmas period, dwarfing all prior periods and bringing us up to a 22.5% year-to-date gain. Usually, I would have waited until the end of the month to make this video, but I wanted to get it done before the start of reporting season. So next episode will mostly be dedicated to the quarterly and half-yearly reports and any gains, losses, or trades that those reports precipitated. Happy New Year, thanks for watching, and I wish you the best of luck this reporting season.